Hello, everyone, and welcome, a very warm welcome to you all on this February afternoon for the third in our Bitcoin and Gold in 2022 ByteTree series. And this week we're going to take a bit of a closer look at gold in particular with John Reade, who we're delighted to have from the World Gold Council. John is the Chief Market Strategist. Just a couple of points of order before we start. As ever, we have to make you aware that this is not investment advice. John's also asked us to mention very quietly that he is a small shareholder in ByteTree, sensible chap that he is. Do please ask questions, fire them through the chat.
Recording in progress.
Bit or the Q&A tab. And also this will appear on YouTube later. We're going to record this. So it'll be there for you to binge watch if ever there are more power cuts like the ones we've had in Suffolk over the last few days. Anyway, without further ado, John, fantastic to have you. I'm just going to, a quick introduction. As I say, John's Chief Market Strategist for the World Gold Council. The mission, as I understand it, of the World Gold Council is broadly speaking to promote gold ownership. Back in the days of yore, that was really much more to do with jewellery, but particularly over the last 5 years or so, they've been more focused on gold's role as an investment asset. John's very much involved, sort of interacting with central banks, top investment institutions, and therefore has a serious ringside seat. And is in a great position to understand attitudes to gold amongst top-level institutions and so on. So let's start with that. John, welcome. Thanks so much for joining us. Institutions have historically not embraced gold, well, certainly over the last 30 years or so. And I know a lot of what you do is talking to them about sort of its role as a portfolio diversifier. But can we just start with why has that been the case? Why hasn't gold been part of the sort of the conversation? And what sort of objections do you get, and how do you debunk them?
Well, first of all, thank you, Charlie. Thanks for inviting me here today. It's a pleasure to talk. And I say almost in the camp of the enemy, but that's not true. I get a lot of questions about gold and Bitcoin, and I'm sure we'll get onto those later. But it's good to be speaking to an organisation such as yourself that is genuine and expert in both, because that doesn't happen very often. Why don't institutions historically invest in gold that much? I mean, it's not that it's unheard of, but it is certainly unusual by historic standards. And I suppose there's a couple of factors. When interest rates were very high, the opportunity cost of owning gold was very high. It's an asset that doesn't pay a coupon or a dividend. It doesn't fit into a conventional valuation model. You can value an equity on the expected stream of dividends that you're going to get, or earnings, or price to book, or any of these measures. Similarly, bond, you're getting a regular stream of income and quite a lot of credit risk from time to time as well. So, but those things are conventional assets that fit into valuation models that investors, particularly asset allocation teams, will look at. And they look at gold and they kind of scratch their head and they think, well, it doesn't pay a yield. We don't really understand it very well. Lots of things seem to move it around. Sometimes it's the dollar, sometimes it's inflation, sometimes it's fundamental demand from, say, jewelry. Sometimes there's a bad monsoon in India and that affects demand. I mean, really, this is too complicated for us. It's not really being seen as being necessary. Its role, I think, now, however, is looking a lot more attractive with equity valuations very high, with bond yields very low, with the opportunity cost of owning gold very low. And with inflation back on, the front pages of all the financial newspapers, and well, if you live in the UK and you're seeing what's happening to your utility bills, it's going to be very much in the mind of individual investors as well. I think gold has come a bit to the fore. So we've been probably concentrating on gold as an investment, probably more like 10 or 15 years now, but almost exclusively for the last 5 or so. Built up a sales team. Now actually realizing that it's not enough to have great data and insights and write lots of research. You've actually got to make the case to investors. They expect to be sold to. There's no sort of process of organic absorption of information. So we built the sales team up, and we're speaking to lots of institutions now, and we've had some good successes. And the trajectory is very good. So if I think about the number of institutions that we're speaking to at the moment, that we're taking them down the process, and because of that, I mean, it's not just knock on the door, here's the returns for gold, and we go and buy some. It's actually a longer process. Now I can see there's a hand in the background from the other Charlie, Mr. Morris. Do you want to cut in?
Hello, John. I didn't want to cut in. I was signaling to Charlie that I'll go next.
Okay, fine. Sorry.
They don't ignore us. We just do sign language to each other. But so you've got the sales team who go to the institutional investor, this multi-trillion-dollar pool of assets. They own lots of bonds, lots of equities. What's the argument? Why should they buy gold?
All right. So I guess the first thing that people think of when they think of gold is that it's an asset that you hope is going to do well in inflation, and it tends to do well during times of crises, but for the rest of the time you can ignore it. And it does do well during crises, and it does typically do well during periods of inflation. But it's more than that. If you look at its returns over the longer term, so since we came off the gold standard in 71, over the last 20 years, it's produced returns in line with or better than other asset classes. So it's not just for the rainy days, it's for all the time. That's the first point we'd make. Second point we'd make is it's a great diversifier of portfolios because it's generally, on average, uncorrelated to equities. So that's fine. But there's more to it than that. Because if you look at its performance when equities are falling fast, so for example, when the S&P 500 is falling by more than 2 standard deviations in a week, it's not uncorrelated to equities. It's actually negatively correlated to equities. So you're now negatively correlated to an asset that's falling fast, which is exactly what you want. So that combination of returns, diversification, and diversification that works when you particularly need it has a big impact on portfolios. So we've looked at typical institutional investment portfolios, like a US pension fund portfolio, over the last 10 years and seen what their performance has been and what they've owned. And then we've looked at adding 2.5%, 5%, 7.5%, 10% gold to it and proportionally reducing everything else, and to see what the impact on that portfolio would be. And in every case we've looked at pretty much around the world, not just the US, but every case we've looked at, we found that adding a small component of gold, somewhere between 4 and maybe 10%, depending on the country and the benchmarks that they're invested in themselves, but adding somewhere between 4 and 10% to a portfolio increases the risk-adjusted return of that portfolio. So it works.
Of course, yeah. And it's interesting you mentioned the 10-year number, because the 10-year number is quite interesting, isn't it? Because that was the last time we were up in these high 1900 territory. And right. So some people say, my God, Bitcoin came along 10 years ago, look what it's done. And gold over the last 10 years has delivered precisely zero, which is, a bit unfair, because I would say back in 2011, that was, the end of a mega bull market. It was the overshoot of a mega bull market. Probably shouldn't have gone much above 1400, something like that.
In your opinion?
In my opinion. And other people would say, for example, I've spoken to some people in the ETF industry who thinks that the ETF itself probably put $200 on the price. And there are various arguments about, so where gold, how it got to where it did. But it's true, it hasn't done much in the last 10 years. I think to look at Bitcoin and say, well, that's gone up 1 million times is a bit unfair, because you start from a market cap of 250K. which, let's face it, isn't really a fair starting point. You've probably got to start about 5 years ago to make it start look a bit more reasonable. Still, you get big numbers, but it's the thing about gold that I don't understand is why it's not bloody obvious. What you've just said is obvious. It's really strong arguments you've made, and why it's just, we talk about the 60-40, why it's not the sort of 55-35-10, why isn't it just standard in portfolio construction?
Okay, I'll give you an answer on that. Who has been making the case that I've just made? And the answer is no one. One of the issues I think that the gold industry has is that it hasn't had persuasive supporters. If you think about the logic or the marketing material behind lots of different people's why you should buy gold, it's that there's going to be hyperinflation coming around the corner. It's that the gold price is being suppressed. It's that, there's all sorts of, I think, silly or even ludicrous arguments made about why people should invest in gold. We have taken this view that what you need to do to get institutional ownership of gold is to talk the language that they understand. And that's returns, that's risks, that's diversification, it's Sharpe ratios, it's all manner of portfolio stuff that, to be frank, is even well beyond what I know. But we have parts of our research team and parts of our sales team that are expert in understanding portfolio construction from an institutional perspective, and getting them out and getting them in front of institutions has made a big difference.
I rather glibly said at the start, everyone ignores it. You're saying somewhere between 4 and 10% is the right sort of allocation.
Yeah.
What is it now, approximately? Do you have any sense as you go around?
We've done a lot of work asking institutional investors, using third-party surveys, reputable stuff, whether they own gold or not. And a surprisingly high number say they do, so more than 50%, which has always come as a surprise to me. And I look at that and I go, nah, that's not right. But then you think about it, it probably is, because lots of them have got exposure to commodity indices or commodity index products, which has some gold in it. Many of them own gold mining equities, maybe in specialist portfolios, or maybe the portfolio manager that quite likes gold stocks. But in terms of what proportion of them own it as a strategic allocation, in other words, something that you don't just have for the bad times, but you have in your portfolio because of the characteristics that I've just described, I guess it's less than 10%. And by the way, it's more than it was 2 or 3 years ago, because we can point at a lot of wins that we've made, not necessarily public wins, so I won't be talking any client names here, just to be sure I don't betray any confidences, but it's an increasing number. And, it's something, and I've been in the gold industry 35 years now. And I wouldn't say I'm at the end of my career, but I've worked more years than I'm going to. But it's certainly going to keep me busy for the rest of my career at the World Gold Council, making this argument to institutions around the world, supporting the sales team, coming up with ways of answering the questions that they come back with.
Less than 10%. I mean, that's amazing, isn't it? Really.
Well, it's not a huge market. I mean, if institutional investors had an appropriate allocation to gold across the board, there would be an awful lot more gold owned by institutions, and probably a lot less gold owned by in jewelry form, because the price would be that much higher.
Yeah. But do you think, I mean, as you say, the phone started to sort of, ring a bit hot. It's not like that old Carlsberg complaints sort of phone, that hardly went off at all. When it did by mistake, it's ringing hot.
At the moment, no.
Is it away from, or is that, is that because people just gone, this, the traditional portfolio is not working, I've just got to find diversification, or is it, gold in its own right is becoming, a proper asset to hold, and I need to get in there?
I think, look, the phones were certainly hot in the first half of 2020. We have one job, and that's gold. So to a certain extent, we are at the mercy of what sentiment and price are doing. But when the gold price started to move up sharply higher in the first half of 2020, we'd never been busier. Just as well, we were working from home, so we could put in 14-hour shifts and not have to worry about the commute. But that was great. But it went quiet. 2021 was a quiet year in terms of incoming inquiries, and I think this is the key about why having a sales team is so important. Because you don't need a sales team when the price is going up, because everybody wants to know what's going on in gold. But when things go quiet, when the price is static in the midst of a massive recovery or a reflation trade going on, people don't want, they don't reach out to talk to you. You've got to knock on their doors and get in front of them. So, I don't need to know where the gold price is. I can just tell by how many incoming emails I've got what's going on in the market at the moment, if you understand what I mean.
Mm-hmm.
I want to touch on that 2020 first half, because when I say 2020 first half, everyone immediately jumps to COVID. But before we actually knew what COVID was, we might have read a couple of articles in the paper, or we might have seen a bloke fall over in Wuhan in a video. But actually, the market was in deflation shock mode already. And so even if COVID hadn't come along, there was something macro happening. Real interest rates have been collapsing over the previous 2 years. And gold smelt a big wall of money coming. And I think it's this gold's nose is a subject that really is worthy of quite a lot of discussion, because it just consistently has a good nose for what's around the corner. 2013, the stall in the gold rally was saying actually normalization coming, tapering, all these kind of things. It was right then. And it was right in 2019-20, before COVID, in saying big wall of money coming, tsunami of cash, courtesy of the Fed. Thank you.
Well, I mean, look, don't forget, the Fed was cutting rates long before any of us. The only person that knew about COVID when the Fed started cutting rates was Bill Gates, because he'd been talking about it for years. Other than that, nobody, and this is one of the points I make about gold. I mean, it had a great performance in 2020, up 25% in US dollar terms for much of the year, until we the reflation trade kicked in about November. It's the best performing asset class through 11 out of the 12 months of the year. So, it did really well. But it did well for two reasons. You're right, Charlie. I was reasonably optimistic towards it at the end of 2019 already, because of what we were seeing in terms of Fed action and the economy slowing in certain areas. But if you think about what all the investment banks were doing when they were writing in November 2019, saying their outlook for 2020, none of them had pandemic in there. Certainly not as a number one or number two risk. They might have had it down somewhere down the bottom, with the usual stuff you put in to cover yourself just in case. And yet gold performed really well. So it is an example of, again, I think one of the reasons I say that people should have it in a portfolio, because it does well during these types of shocks, the so-called Rumsfeldian unknown unknowns, things that come out of the left field that we never expect. And look, I mean, that's going on at the moment now with the sudden increase in geopolitical tension in the Ukraine.
Can we move on to slightly what you're seeing on the demand side from the central banks? We talked about the institutions here, but obviously central banks are a huge component. It's always kind of interested me, because it wasn't so long ago that those central banks or governments confiscated gold.
From
how old are you? That was 1933.
It was 1933, but I mean, yeah, okay, I am getting on a bit, and the voice is going a bit as well, John. But the point is, so it always seems to me that there is almost a possibility of hostility coming from central banks, because gold acts against the currents, the local currencies, and act against it. But I mean, what do you find when you walk into a central bank and talk about gold and sell it as a sort of an asset of value storage?
I mean, look, central banks and gold is a very long story, and if you go back to the confiscation in 1933, there was an explicit link at the time between the dollar and gold. There isn't anymore. Central banks used to really, really care about gold when they were linked to it. Now that they're not linked to it, most central banks that own a lot of gold don't actually think about it very much. They did go through a stage of selling it, quite enthusiastically. I think, and I'm going from memory, I haven't got the chart in front of me, but 27 years in a row, I think they sold gold up until 2009 on a net basis. And that was banks that at the end of the gold standard, because they were large, important countries financially, had ended up with a lot of gold in their foreign exchange reserves, and had made up a very large proportion, 30, 50, 80% in some cases. And they weren't earning any yield on it. And there was lots of, high quality AAA government bonds out there paying 3, 4, 5, 6%, depending on when you were talking. So they were selling gold. Developed market central banks were reducing their gold holdings, primarily Europeans, plus Canada, plus Australia, plus a couple of others, but it was basically Europeans. And then the global financial crisis came along. And suddenly there weren't as many AAA rated government bonds out there, and they weren't paying any interest either. So, you think, well, what are we going to have? And oh, by the way, this gold that we've been selling is suddenly now worth a hell of a lot more than it was when we sold the last lot. Do we really want to keep selling this asset now? So developed market central banks stopped selling almost completely. At the same time, if you cast your mind back to the Asian financial crisis in, end of the 90s, I think it was.
97.
Yeah. One of the lessons I think that emerging market central banks have taken away from that is we're not going to get caught again. We're not going to get caught with too few international reserves. So they built up massive holdings of foreign currency. Fine. So now they've got massive FX holdings. They don't have much gold, some none, most of it like tiny amounts, because at the end of the gold standard, they weren't big central banks. Now they are. So many of them started to diversify some of their G10 currency holdings or G3 currency holdings into gold. So we've seen now, I think it's 11 or 12 years of consecutive increases in net central bank holdings, and 2021 was a good year. Not as good as 2018 or 2019, but certainly much better than 2020, when central banks, to be frank, had other issues to face, including in some cases a loss of reserves and some currency weakness because of the recession caused by the pandemic.
I mean, the type of central bank that's buying versus would like to sell has changed as well, hasn't it? Because you alluded to the OECD aren't accumulating, but the non-OECD are accumulating. In a nutshell,
that would have been completely true until last year. We actually saw, and I assume Ireland is part of the OECD, certainly a developed market. And I assume that Singapore is as well. Both of those countries bought gold. So for last year, we actually had 2 developed market central banks come and buy gold, which was like, oh, that's interesting, because it's mostly been emerging market central banks for the last 10, 15 years.
Very much developed countries than both. And both of them kind of financial center, offshore financial center, trading ports to some degree.
Yes. One Asian tiger, one Celtic tiger, as Williams would call it. Yeah,
you nailed it right there. So it is interesting, and I do think that when you see what Russia's done, they played their cards so well on the monetary side. I'm not suggesting I'm very happy with what their actions are, but we'll move on from that. In terms of sheltering themselves from sanctions and making their economy resilient and building up the gold reserves. So what can the West do to them financially when they've got loads of gold and they've got hardly any dollar debt?
I think the thing is that Russia has been buying gold since about 2004, 2005. I remember that one of the Central Bank of Russia representatives at the London Bullion Market Association conference, which that year was held in Johannesburg, announced that they were going to increase their holdings in gold to 10%, and caused a big rally in the gold price as a consequence. But they stuck with what they said they were going to do, coming in, buying, slowly and steadily at about 10 tons a month, and then increased that a few years ago to a roughly 20 tons a month. And then announced last year in April, I think it was April 2020 or 21, I can't remember, I'm getting old, it had been April 2020, that they weren't going to add any more to their holdings, because, to be frank, they've taken their holdings up to about more than 20%. And 20% of your foreign exchange reserves in gold is a big number, particularly for an emerging market central bank. There are some legacy holders that have more, but as an emerging market, that's a big That's a big number. And they said, look, we've bought enough.
Yeah, and the thing is that in the credit crisis, the ruble goes down, 33%. Around 2014, it goes down 50-60%. And this time, the ruble hardly goes down at all.
Yeah, I mean, one of the things, without getting into the performance of the ruble, if you look at the oil price in rubles, it doesn't move very much. And the oil price is high, so the ruble's high. That would be my interpretation at the moment.
So in nominal terms, they've got the perfect hedge. Yeah,
pretty much.
Good point. Good point. Well, I think that part of the world is pretty interesting, not just from the gold perspective at the moment, but also from the Bitcoin perspective, because the threat of sanctions. I mean, there are so many different ways of talking about these sort of assets, gold, Bitcoin, which are kind of diversifiers, somewhat off-grid, alternative money, real assets, or pretending to be real assets. I mean, Bitcoin is unproven as that, but the narrative is certainly a real asset, and that's the hope. And it's interesting that both Russia and Ukraine are currently through their parliaments. They're looking at legislation to accept crypto in particular, and it's all part of the workaround. And I just, one of the things that we at ByteTree we keep coming back to, the reason we like the gold Bitcoin combination is because they just work so well together as a pair. There we are in gold, has a lovely 18, 19, 20, as we said earlier, 2020. The price of gold goes up a lot. Bitcoin does very little over that period. In fact, it's quite scary in most of the time. And then you literally hand the baton, gold to Bitcoin, in late 2020, and off it goes. Does great things. Gold slumps. Everyone says gold's a barbarous relic again, as they always do. And then the world gets into trouble in 2020, and the baton goes straight from Bitcoin back to gold. Up goes gold. Everyone worries they haven't got enough in their portfolio. And Bitcoin, hot potato. And it keeps on happening. And I think that one of the interesting things about Bitcoin, like gold, is it doesn't sort of have a CEO. Commodities don't have a CEO or a board. They're just an element. And Bitcoin's a kind of electronic element, if you like, in a sense. And they don't have earnings. And that's actually quite a nice thing. There's a consistency about them, which is somewhat beautiful. The gold doesn't say I've had a profit warning, or I'm not as shiny today as I normally am, and Bitcoin doesn't say, well, I'm not as divisible as I was yesterday, or the block time does change a bit, but you know what I mean. The blockchain will say, I'm not working properly. They just carry on, and I think it's that constancy, and when you've got networks with proper global distribution. I mean, everyone in the world knows what gold is. And everyone in the world under 50 knows what Bitcoin is. I used to say under 40, but I'm going to extend it to under 50. and that's powerful, isn't it? They have something in common there.
Well, certainly I can talk about gold. I mean, it's got great brand recognition. Everyone knows what gold is. You've got a block of it in the background there. I assume it's fake. Otherwise, you've got better security than I think you have. The fact that you can throw it around like that shows that it's fake. But people will know what that bar is, represents. Bitcoin, I'll be honest with you, I don't think we're there yet, and I don't think it's fair to say that everybody below the age of 50 knows it. I think in the developed world, I think there's a much better understanding of that. But there are people without access to banking that may not be particularly literate or numerate that own gold. So it has great penetration from the richest hedge fund managers in Midtown New York to rural India, China, etc.
Well, that's okay. Let's talk about that, because you've got the top of the food chain. You've got the central bank with loads of money. They love gold. They don't like Bitcoin. Then you've got the institutional investor who doesn't know what Bitcoin is and is wary about gold, generally speaking. Then you've got the high net worth, the family office, which loves gold and increasingly is, the young kid in the office has been told to go and have a look at Bitcoin. Then you've got the sort of wealthy private investor, top 10% or whatever, and they're probably sort of somewhat engaged with both. Then you've got the sort of youngster in the emerging market who's all over crypto, and the youngster in the crypto, and the perhaps not so young person in an emerging market who's all over gold historically, the sort of culturally India and so forth.
Yeah.
And then, I'm sort of wondering who in an emerging market would sort of love gold but not like Bitcoin. Because if your currency is fundamentally weak, if you're sort of brought up with the idea that your currency goes down year after year, which is sadly true for lots of countries, you've got a few years now where you say we've got two opportunities here. You could do old school, mum likes gold, dad likes gold, but kids like Bitcoin. I mean, you see places like India, they've now got a central bank digital currency. It's been a bit of a success. And then, so many different countries have now got these projects, and all the kids are mobiled up to their eyeballs, aren't they?
They are. I mean, I think, look, you raise an important point. I mean, we've done a lot of work, again, survey work, asking investors and actually jewelry buyers as well as two separate exercises, what they think about gold. Are they likely to buy it? What's going to trigger them to buy it? Why don't they buy it? All these sorts of questions. And as you can imagine, we've been increasingly asking them about crypto in the same surveys as well. And it is interesting to see how, call them investors, retail investors, view both assets. There is, and it's one of the reasons why I think that they do work very differently, is because the buyers see them as different. If you ask them whether they think that, or what they think about crypto assets, they see them as assets that can give them potentially very high returns. They don't recognize them necessarily very much as a store of value. Whereas if you look at what they think about gold, very much the other way around. As I say to people, you don't buy gold expecting to get a Lamborghini at the end of the month. You don't buy gold expecting to make 5,000% this year. You buy gold largely to hold on, to protect your wealth, and protect it against the declining currencies that you spoke about. So I'm quoting you now, Charlie. One makes you rich, one keeps you rich. And that's very much the opinions. It's as if they have been reading your stuff. That's very much the opinions of the consumers that we've spoken to around the world.
That's an incredible quote. Well done, that man. Now, I want to talk about volatility. So Bitcoin typically is known for being volatile. But by the way, it's the least volatile crypto. If you
what is that? The best looking horse in the slaughterhouse? Yes.
And that's assuming you leave out the ones that have stopped trading, or the stable coins. And
right.
But gold's got this extraordinarily low volatility, and it's historically 18%. Nowadays, 15 or less.
Yeah.
And I mean that is incredibly low. I've always said that it's approximately the same volatility as a 20-year Treasury bond, which seems to be about right. But that's not a perfect match. It's less volatile than the long bond, and it's more volatile than the 10-year, and it's always sort of bounces around between the two. Why do you think gold maintains, even during the rough patches, we only see very, very short-term spikes in gold volatility, and it just goes straight back to being so calm?
I think it really comes down to price elastic components of demand and supply. On the demand side, when the price goes up a lot, it's always because of investment demand. Okay, so investors are buying gold with both fists, driving the price higher, whether that's in physical bar on coin, whether that's via ETFs, whether that's by COMEX futures, OTC market, doesn't matter. Investment demand drives gold up. But investment demand on average over the last 10 years has been about 42% of net gold demand. Consumer-related demand is about 41%. So 34% in jewelry, 7% in technology. And particularly the 34% in jewelry is very price sensitive. Now, it may not matter too much to you and I what the gold price does when we're buying jewelry for our partners or wedding bands. But for countries that consume a lot of gold and where they're buying it at a very low premium to its intrinsic value, price matters a lot. So when the price goes up, they buy less. Similarly, on the supply side, Mine production doesn't really change very much. It goes up by 1 or 2% typically, and then maybe, coronavirus interruptions down a few percent as well. But generally speaking, it's grown by 1 or 2% per annum over the last decade or so. So it doesn't really matter what the price is doing there. Miners, keep producing gold. It's what they do. They have one job and they're pretty good at it, and that's to produce gold. But that's only about 3/4 of supply to the market. The other quarter comes from recycling. And that recycling number can really change. It's the recycling of old jewelry. So when the price goes up, you get a lot of people taking their gold, old jewelry maybe from the back of the drawer or from ex-boyfriends or ex-husbands or whatever. They take it, they cash it in, and they sell it because they see the price as high, but potentially one of the reasons gold's going up is because bad things are happening around the world, and maybe they've lost their job and maybe they need to put money on the table. So a very big component of the previous all-time high during the global financial crisis was scrapping of gold jewelry, particularly coming out of Europe and the United States. So that combination, when the gold price goes up, you see demand falling from the consumer side, you see supply increasing from the recycling side. And similarly, when the price goes down, same thing happens. Gold's on sale now in jewelry shops, and people don't think it's a great time to cash in their old jewelry. So you've got natural buffers. You've got things like technology demand, which doesn't really matter what the gold price is doing from a year-to-year basis. People buy gold and put it into technology because they want to, because they have to, because of its intrinsic qualities of ductility, conductivity, corrosion resistance, you name it. So the tech demand sector is very, very sensitive to what's going on in global industrial production growth, and that's another out of sync demand application for it. So you've got this diverse collection of demand and some price elastic supply coming in as well, and that just means that when the price moves, there are big components of the market that react to that, and that prevents it from going too high or too low.
I just want to bring in a couple of questions that have come through, and it touches on the sort of contradiction, of course, of people looking for things like Bitcoin and gold when things are tough as a way of protection, but also this idea that if things get too out of whack, governments get stuck in and they start confiscating. And we touched on it, not earlier, but do you think there is a danger ever again, John, that gold will be confiscated by governments? And I'll put the same to Charlie, if I may, about Bitcoin being heavily restricted by regulation of on-off ramps.
So from a gold perspective, I wouldn't rule out governments confiscating any assets, under certain circumstances. But I don't see why they'd pick on gold preferentially. It's not connected. There's no hard code anymore between gold and money like there used to be. It's not necessary if you want to devalue your currency to take all the gold out of circulation so that you own it, so that when you devalue the dollar and revalue gold, then the government makes all the money, which is kind of what happened in 33, 34. There's no need for that now. I mean, they might be confiscating Lamborghinis, they might be confiscating houses and saying you can only have half each, sort of thing. I don't see why gold would be singled out. To be frank, there's lots of other financial assets that are easier to confiscate, and just look at what successive UK governments have done to pensions, for example.
Yeah, I think, John, what you're saying there, to put a sort of fairly crappy analogy into it, is gold's a sort of liquid grand piano, in the sense that the grand piano was one of the hyperinflation hedges, as is a second-hand car. But this is not a liquid market; it's a bid-offer market, isn't it? And gold is a sort of liquid version of that, but it's not a threat to the official financial sector.
Correct.
It once was. And I also like to make the point, which is never made by anyone else in the world apart from myself, but I think it's a good point, but I would do, it's my point. But that is that the gold was also the original fintech, because an ounce of gold was a way of measuring value in Shanghai, as it was in Santiago, as it was in London or Amsterdam. And before communications, and it's I don't think it's an entire coincidence that the fiat monetary system came to be at the time that communications allowed it. And it came around in the 70s, just as computing was getting going and wires in the ground. So I think that's actually quite important. It's not a total coincidence. It wouldn't have been possible for the fiat system to have thrived much earlier because I don't think the world was ready for it tech-wise. But on the Bitcoin side of it, in the Trudeau reference to the Trudeau question, the banks have already been quite difficult. And I mean, just watch Russia. So if your view is that the existing system can shut crypto down, well, I was just looking at the number of stablecoins today, the level of outstanding stablecoins today. It's huge. There's more stablecoin today than there was crypto a few years ago. I mean, we're talking nearly $200 billion of cash, of digital cash sitting out there. So this is becoming a proper market. Watch Russia the sanctions so far have avoided Sberbank and VTB, but if they go the whole hog, watch Russia find workarounds. That country won't stop. It will carry on. And I think this is the point. If you try and ban things, and the workaround comes. The reason we have all those stable coins is because of the banks being restrictive on the crypto space. So the innovators came forward and said, how do we get around this? And so they created their own digital cash. And so I think that, if Trudeau regulates the space out of existence, expect it to grow faster is actually the lesson. Disruption in the short term, but bigger in the long term. There'll be more need for it. You'll win the argument with more people. I mean, right now, you have to say you have to be a baddie to love crypto. You have to sort of be trying to buy drugs on the internet in a dark place or trying to assassinate someone. But if the governments keep shutting everything down and regulating it, then the sensible people come along. And before you know, you've won the argument entirely. So, liberal democracies should not be banning new technologies.
John, do you have any sort of valuation frameworks around gold? How do you think about it? And also, it's held up incredibly well. Where do you think we're going from here?
One of the questions that we've had from institutional investors repeatedly over the years, and we weren't able to answer it, is, how do you value gold? Now, there's lots of, fair value type calculations that are done by investment banks that look at financial metrics only, look at, the US dollar, look at real yields, for example. And they kind of work pretty well in the short term. So when I was sitting at on a gold desk at an investment bank, that's kind of how I modeled gold, looking at positioning, looking at the dollar, looking at interest rates. But it doesn't, it can be really useful in the short term, literally 3 months, 12 months. But if you think about the long term, it hasn't, you have to recalibrate your model all the time, and that's fine. And again, as long as you're only looking at the short term, it doesn't really matter that much. But if you're thinking over the longer term and you actually want to say, well, where should gold be valued and what sort of return should I be plugging into my asset allocation model? Because, we know what to expect of bonds, theoretically. We know we've got an idea of the equity risk premium and what that should give. But what's the appropriate number for gold? Is it zero real? In other words, gold holds its value over the long term, or is it something else? So we developed a valuation framework really over the last, I guess I'd say 5 or 6 years, actually predated me being at the World Gold Council. It was done by one of my colleagues, championed by one of my colleagues in New York with quite a lot of external help. So the valuation framework takes into consideration elements of supply and demand and what drives those. So we've looked back where we've got decent data, so typically over the last 30 years, and say, right, so what drives jewelry demand, what drives central bank buying, selling, what drives technology, etc. It's allowed us to build a fairly decent sized quantitative model, which you plug in macroeconomic forecasts, and it tells you where gold should go, and it works pretty well. It's all available for free on our website. Now, at the moment, it only works on annual averages, so useless to private investors trying to work out where the next $100 in gold is going to come from, but it's pretty good at telling you what the returns are likely to be over the next few years, and from my perspective, crucially, generates a long-term return as well, which is between 4.5% and 5%. Now, and again, this is where we contrast to crypto. 4.5%, 5%. I hear you say that's a poor return. Yeah, true, but it's better than zero real. which is the only thing we used to be able to go around and say. It's an asset that holds its value in the long term. So why does gold increase in the long term? What's behind this model? Well, it comes down to economic growth. Because the consumption side is driven by wealth, it's driven by income, the bigger the global economy gets, and the richer people get, the more they spend on jewelry and technology. And to a certain extent on certain aspects of investment, if you think about the idea of regular savings. So that drives it as well. The shorter term drivers of gold, very much driven by risk and uncertainty. And that's what's driving investment and speculation. And one of the things that amazed me from all the focus that I had over my long career at funds and investment banks is I'd pay tremendous amount of attention to the positioning and flows that were taking place by leverage money. And that's really important in terms of determining what's happening in the short term. In the long term, it kind of cancels out. Sometimes they're buying, sometimes they're selling. So they're responsible for a lot of the chop in the beginning, but over the long term, it's very much driven by economic growth.
So that's a recognition by the World Gold Council that the price of gold has moved on from Roy Jalstrom's golden constant, just being the same price of everything over time, and somehow hanging on to the money supply or to normal GDP or GDP per capita or these sorts of measures of economic progress around the world.
That's very much what it's come down to. Yes.
Yeah, I mean, I spend lots of time thinking about those sorts of things, and if I ever upgrade my valuation methodology, that's the route I'll be going down. But honestly, I've been so busy in the last few years, I've not got around to it.
Well, you can always use ours. It is available on the website, and if you'd like to chat to the guys that spend all their time on it, be more than happy to put that together, put that meeting together.
Well, yeah, I'd love to actually. But you need to I need to go back to HSBC for 2012, like I did. It was just a year to think, It was like a gap year in finance. It was thinking. They stripped you of all your responsibilities, in a post-crisis world. But I want to go to the elephant in the room, which is the stock-to-flow model. And you've mentioned gold supply, and gold supply means mined supply, and it means recycling of gold coming back to market for the second time. And the gold new supply is about 2% a year, and the Bitcoin new supply is about 2% a year. So without getting into decimal points, and they're about the same. How important do you think that number is? So if the gold supply in the next few years went up to 3% or went down to 1%, how much difference does it really make, in your opinion?
Yeah, it's an interesting one. I mean, think of it that way. If you wanted to say the stock to flow model in gold was to go from, it's not quite 2, but let's not talk decimals, but to go to 2% to 3%, that would be gold production increasing by 50%, pretty much. That would have an impact, and it would have an impact. And again, because if you think about the way our valuation model on our attribution model think about it, supply to the market, demand to the market, and then you balance it and you adjust for price. So it would have an impact. But the bigger impact, I think, would come over the longer term. One of the issues that we can see looking at the gold mining industry is that they've managed to grow production really well in the last 20 or 30 years. But it's getting harder and harder now to grow gold production and even actually to keep gold production static, because a lot of the mines that were in production 20, 30 years ago are gone. I mean, South Africa when I worked as a mining engineer, South Africa was producing 600 tons a year and more, actually peaked at 1,000 tons of gold production in 1970, and it's now below, it's around about 100 and something, maybe a bit below, maybe a bit above. I don't even pay attention to it anymore. So there's no doubt that supply growth is important. And if you were to tell me that stock to flow number was to go from 2% to 3% overnight, then I would expect the gold price to fall quite a bit. I'd have to look at the model to see exactly what we predict, but it would be considerable.
So that if that asteroid or meteorite or whatever it is that's full of gold landed next to Newmont's operations, and suddenly the gold supply, this is what you see on crypto Twitter, and they say that if a big meteorite full of gold hit the planet, then that would be
then we wouldn't have to worry about anything. It would be probably an ELE, an Earth, what they call it, an extinction level event. But anyway,
I could turn it around. I think Earth is going to bump into the meteorite. I think it's the only And it's because we actually want that gold. We need more gold.
Yeah, I mean, look, there's no doubt, or no reasonable doubt, that there are asteroids out there with gold and platinum and other metals. And one of the things I've said to people is, I am sure that the metal contained in asteroids will be part of our journey to colonize the solar system and eventually the stars around there. But if you look at the energy cost to get up there and the energy cost to bring it back, it doesn't seem as if it ever would be worthwhile to do so.
We'd need Nord Stream 3, wouldn't we?
Yeah. Anyway.
Well, that's a nice segue into the thorny issue of ESG, isn't it, really? Sending, going and mining asteroids, anyway. Yes, but as Mr. Institutional Investor, do I have an issue with gold from an ESG perspective?
You might do. I mean, a lot of institutional investors look at extractive industries with concern. There are good reasons why the gold mining industry is doing a lot to try and address those concerns, and we're a membership-owned organization owned by the big mining companies, and we're doing a lot of that work as well. We're spending, the ESG team is if you think crude oil prices have gone up recently, you want to see what the ESG team has done at the World Gold Council in the last 3 or 4 years. We've got lots more people there now looking into all of these things. There's a number of different areas that we're operating in. One of which is to quantify the carbon emissions of gold mining production, and developing a credible pathway by which the gold companies can get to net zero. A few of them signed up to that, and I think we'll see more and more of those do so. But there's also recognition as well that gold contributes to the United Nations Sustainable Development Goals as well. It's a really important, gold mining is a really important sector to many developing countries, and has the potential to make a real positive difference to those countries and to those economies. And again, we're quantifying that. We're talking about that a lot more. In terms of the threat of illicitly mined gold or illegally traded gold, the industry's done a lot to introduce what we call responsible gold mining principles, which is an attempt to clean up the supply chain such that all the big refineries that are recognized by the London Bullion Market Association are taking gold which is responsibly produced. But it's tough. I mean, as you guys know from the crypto side, there are a lot of illicit actors in every economic field, and if there's a profit to be made, then it draws them like wasps to jam.
Yeah, I think that to win the ESG argument, I mean, is always going to be difficult, because you end up asking questions about whether you're allowed to smile, consume energy and smile for whatever reason, listening to a song whilst you're running or something.
I'm not quite as cynical as that, Charlie.
But let's not go down that route. I think that the argument just needs to be made for all stores of value, or firstly, the market's open to competition. So if a new store of value wants to come along and have a go, fine, it's welcome. No one stamps monopoly of store of value on gold, and other things are allowed to do that too. And the fact that a store of value is a legitimate use case. It's actually a very important use case, because you look at what we've done to the financial system over the last 20 years with, printing money, ballooning debt in Western society, and sky-high valuations of asset prices. And that's not good. And so it's really right that people are able to store wealth. And certainly if you look at things like the Herrengracht Index, which goes back to the 1700s with Dutch house prices, not Dutch house prices, the Herrengracht Index, is Herrengracht district of Amsterdam. Now, it's not called Herrengracht, it's called something else, which I can't possibly pronounce, but it looks a bit like Herrengracht when you read it in English. And apologies to Dutch people who would say that doesn't sound anything like that. But they've measured this, time series over 300 or 400 years of real Dutch house prices. And the answer is that right now they come out as very high compared to history, which is true all over the world. But they're a mean reverting, zero value creating series historically. And that's fascinating, which comes back to the old argument about, is gold just a constant through time? And we're just living through an illusion right now. And we'll soon find out what that means. Or is this GDP growth and all the rest of it real? Has it actually happened?
Well, it's worked pretty well over the last 30 years in terms of our valuation model. And look, I agree with you. You can certainly question a lot of the increases in asset values over the last, you said 20 years. I'm not going to argue that. But you also can't argue with the fact that there's a lot of wealth in emerging markets. It simply wasn't there 20 years ago.
Yeah.
For all of the ills, arguably, of the financial system over the last 20 years, we've taken a lot of people out of poverty as well.
There is that. And one just hopes that the system can sustain so we don't put them back in and more.
Yeah, indeed.
Depressing thought. We can't end on that. Happy thought, please, someone.
Yeah, I was going to say we're probably coming to the end of the sort of the standard hour. So if you've got a question, fire it into the chat box as soon as you possibly can. But what I'm sensing, John, as we sort of think about all this, is that we've got at the margin increasing demand from institutional investors who, for the first time in a generation, are having to sort of question or think about how they allocate away from equities and bonds. Central banks are not net sellers, as I understand.
Net buyers, yeah.
Net buyers. So, these are two very meaningful constituents of the investment universe who are buyers at this point. The question then is who would be the sellers? Who's on the other side of that trade, or are we at the start of a bull market? And are there any signs that this is what do we look for in terms of sort of frothiness? When do we know that things are silly?
Well, and a couple of things I'd say. I think there's a secular trend, if we do our job properly, the World Gold Council, of persuading institutional investors they should have gold in their portfolio. And it's been successful over the last few years, and I expect that success to continue. But within that trend, you get periods of accumulation, and you get periods of call it profit taking or position reduction. We certainly saw that from speaking to some of the people that we know very well back in November 2020. Gold had gone up well. Suddenly, all these good Pfizer vaccine results were coming out, and crypto came back to life. And the reflation trade was back on. People explicitly reduced their holdings in gold tactically to buy into reflationary assets. So the secular trend, I think, is intact, but there'll be cyclicity. There'll be times, to be frank, like in November 2020, when you don't need diversifiers, you just need to buy equities with both hands, and that's really what the whole buy the dip mentality of 21 was all about. But that we have to accept that even though we make the case of gold strategically and say you should have it in your portfolio all the time, people will flex around that allocation, even where we've been successful in making that case. I think gold will see growing ownership from investors in the medium term, and I think central banks, based on the conversations that we have with central banks, and we've got relationships with virtually all of them, I think they're going to continue to buy on a net basis, and I don't see any signs of the developed market central banks that own good quantities of it coming back to the market and selling. It would be domestically politically unpopular. So I think it's a good environment for gold, whether it's the start of a long-term bull market or not. Yeah, as I say, there is a fair amount in the price at the moment, I think, because of the geopolitical conflict that we've seen, and certainly the rally we've seen this year has been affected by that.
I'm going to pick up on this question in a second. But I just want to do a little wind up, John, if you don't mind, before we go. I know you're not allowed to give your forecast for the gold price. So that's been very clear to us. I'm not going to, even though we keep going around this side saying, what about demand, supply, and this sort of thing. You're not going to give your gold price forecast. Do you have a Bitcoin price forecast?
No, I don't. I don't, but I do have lots of potential, demand outlooks for Bitcoin. Like I have demand outlook. No, I'm joking. I don't think about Bitcoin prices as something that I have any business in forecasting.
Could you give me higher or lower on a 10-year view? Personal opinion.
I have no idea, and you can try and put me on the spot. And so I genuinely don't know.
I've done that, but you're not answering it, Dana, and that's fair.
Exactly.
And Charlie, we better wrap up soon. But there's a question. take that?
I didn't understand the question, so I didn't.
I think it's use cases for gold, basically. Outside of stored value, jewelry, and so forth. Are there any sort of tech use cases?
Yeah, there is. There's more technology demand for gold in tonnage terms than goes into platinum or palladium, but it's a bigger market. So it's only about 7%. And as the world becomes more connected, you are going to see more gold used in technology. But you've also got the other side of the coin, which is miniaturization and thrifting. So I think tech demand for gold at 7% of total demand is probably about the number we're going to see going forward. Very cyclical, as I've mentioned before, with the economic cycle, but I don't think we're about to explode to the moon because of technology developments.
Very. Why is it good for miniature stuff?
Well, the point is that electronics get smaller all the time. So it's used in bonding wire, it's used in integrated circuits, and they do more with less space all the time. So,
and that's because it's a good conductor, right?
Good conductor, number one, but it doesn't rust, it doesn't corrode, and it's ductile. Silver's a better conductor than gold, but you can't use it because it both corrodes and then snaps under temperature extremes and duress, etc. So if you've got a connector that really needs to work when you want it to work, my example I use here is an airbag. The electronic connector in an airbag is made of gold because it sits in your car for 7 years, high temperatures, low temperatures, completely ignored or whatever, and then the one day when you crash into a truck, it needs to work. So you make it up. You use gold in that application.
There you go. What an advert! I love that.
So, but there's not a sort of a secular growth thing like electrification of cars or something like that.
Yeah, there is absolutely, because all the electrification of everything will require more integrated circuits, more gold, but it just gets smaller and smaller every integrated circuit range that comes out. So you're racing to stand still in terms of technology demand for any metal, which is something I think that some of the other boosters of some of the other precious metals in terms of electronics uses sometimes miss, is that when the price goes up, companies are very smart at using less.
Yeah. Brilliant. Well, I think we've exhausted everything. Particularly you, John. It's amazingly kind of you to spend your time with us. It's been utterly fascinating. It's going to be a huge subject, this, I think. We're just at the start of a new conversation that hasn't really been had for many years properly. And if I can cut in and say things. First of all, thank you very much. It's great to be able to talk to a slightly different audience about gold. Second thing I'd say is all the stats, all the data, all the tools, the valuation framework, etc. It's all available on our website, gold.org. And please go along there. It's free. First time registration needed, that's all. And after that, it's free to access. And if you want to contact us, all our contact details are there. I'd love talking about gold. I describe myself as the world's most boring dinner party guest because I've been doing gold for 35 years in one form or another. And I like to think I know an awful lot about a very, very small segment of the world. But if you've got any questions on gold, more than happy to try and answer them. And if you've got any questions on Bitcoin, go ask Charlie. Well said. John, thanks very much from both of us. Do you think it would be a good idea to put Bitcoin and gold into a kind of volatility adjusted savings product?
What I say, I don't have a view on Bitcoin because I'm from the World Gold Council. I'm here to talk about gold. But one of the things we do say to people is that if you've chosen to buy a risk asset like Bitcoin, you've added risk to your portfolio. Okay. And therefore, what you need to do is you need to increase your hedges. You need to increase your diversification. Therefore, if you add Bitcoin, you should add gold as well. So that's kind of answering your question.
Yeah, good point.
Wise words indeed. John, thanks very much. I think we'll call it a day. Thank you so much, everyone, for joining us. Charlie, thanks very much. See you next month.
Thank you. Cheerio, guys.
Yeah. Bye.